Okay, I want you to imagine a future for a second. A future where the whole idea of a career path, that steady climb up the ladder, it doesn't really exist anymore. Think about a world with advanced AI, maybe even something like a universal basic income, where those predictable raises you count on are just gone. How in the world do you invest for that? Well, we're about to dive into the answer. It's called the post-work portfolio. So let's just kick things off with a pretty jarring question. What if you never get a raise again? I'm serious. Think about it. What if the primary way most people build wealth, a bigger and bigger salary over time, just stops? This isn't some far-off sci-fi concept. It's a real possibility in what some are calling a work-optional economy. And if that happens, believe me, the old investing playbook gets tossed right out the window. And this brings us right to the absolute core idea of this whole explainer. It's a huge shift in thinking, from obsessing over net worth to focusing on cash flow. We've all been trained to watch that 401k balance like a hawk, hoping it goes up. But here's the honest truth. You can't pay your rent or buy groceries with your net worth. It's just a number, an abstract number that can literally get cut in half during a bad market downturn. Cash flow, though, that's totally different. That's the real, spendable money hitting your bank account every month. It's what you actually live on. So here's our game plan. First, we're going to tear down why the old growth model is basically becoming obsolete. Then we'll get into the secret that separates the pros from the amateurs, the big battle between capital gains and cash flow. After that, we'll get our hands dirty building our very own cash flow machine. Then we have to face the brutal truth about inflation and design what's called an all-weather defensive portfolio to protect ourselves. And finally, we'll wrap it all up in a neat little blueprint you can actually use. All right, first things first, let's talk about the obsolete growth model. We're going to look at why the financial advice our parents probably gave us might be, well, dangerously out of date for the world we're heading into. So the whole traditional buy low, sell high thing is about one thing, making your pile of money bigger. And look, a big pile of money is great, no one's arguing that, but it doesn't solve a fundamental problem. If your main paycheck disappears, you can't just start selling off little chunks of your 401k to pay for things, especially if the market's down. That's kind of like being forced to sell your living room furniture to keep the lights on. What you really need is a system that spits out cash without you having to sell the machine that makes it. And that leads us to the real mental flip, the huge difference in philosophy that really separates the professional investors from the amateurs. Man, this quote just nails it. It perfectly captures the whole idea. Amateurs are always chasing that home run, right? That one hot stock that's going to make them rich. It's basically a lottery ticket mindset. Professionals, though, they're not gambling. They are building a business. They do that by buying assets that produce predictable, reliable income, month in and month out, like clockwork. And this analogy just makes it all so clear. Just think back to the 2008 financial crisis. Imagine someone owned a house worth 300 grand. The market crashes, and bam, overnight it's only worth 200 grand. Their net worth, on paper, got absolutely demolished. But you know what didn't change? The renter living in that house? They still had to cut a check for rent on the first of the month. The cash flow kept coming in, even when the asset's value was all over the place. That is the power we are talking about. So, how do we actually do this? How do we build this thing? Let's switch gears from the why to the how and talk about actually putting together this cash machine. Okay, these are the main engines for our cash flow machine. We're talking about assets that are specifically designed to put money into your pocket. You can see things like income-producing real estate, selling options, dividend stocks, bonds, even things like business royalties. Now, for this deep dive, we're going to focus on two of the most powerful and, honestly, most accessible engines here, options and real estate. Let's start with engine number one, options. Specifically, a strategy called a covered call. Honestly, the easiest way to think about this is that it's like you're renting out the stocks you already own. Simple as that. Just like a landlord collects rent, you collect something called a premium from another investor. In exchange for that cash, you give them the option to buy your stock from you, but at a specific higher price in the future. Now, whether they buy it or not, that premium, that rent money is yours to keep no matter what. The risk, of course, is that the stock skyrockets way past your set price and gets called away. But for an income-focused investor, that's often a pretty good problem to have. Now, this all comes together in this really powerful system some people call the wealth wheel. And this is where it gets really, really clever. It starts with you getting paid to buy a stock that you already wanted to own. You sell what's called a put option and collect cash, a premium, just for agreeing to buy it later. Then, if the stock price drops to your target, boom, you get assigned the shares at a price you were already happy with. And now that you own the stock, you start generating income by selling those covered calls we just talked about, all while you're also collecting any dividends the stock pays. Finally, if the stock price goes up and your shares get sold, you make a profit on the sale and you can just start the entire cycle all over again. I mean, it's a complete system for turning stocks into a consistent income stream. It's pretty brilliant. Okay, on to our second engine, real estate. And this is where we get into this amazing concept called phantom income. This is one of those rare times where the tax code can actually be your friend. See, when you own a rental property, you get to take all these deductions, like for depreciation, which is just the theoretical wear and tear on the building. This can actually create a loss on paper for tax purposes, even while the property is spitting out positive cash flow. So you're literally putting real money into your pocket that is legally sheltered from taxes. So a super popular strategy to scale this up is called the BRRRR method. Some people call it the infinite money hack for real estate. First, you buy a property that needs some work. Then you rehab it, fix it up, which forces its value higher. Next, you rent it out to good tenants, proving it's a solid income producer. Then comes the magic step. You refinance, doing a cash-out loan to pull your entire initial investment back out, completely tax-free. And finally, you repeat the whole process with that exact same money. It is an incredibly powerful way to buy property after property using the same capital over and over again. All right, so building these cash flow engines sounds amazing, right? But it's not enough to just build a machine that prints money for you every month. You have to protect it. And there is a huge, lurking threat we absolutely have to talk about. It's the silent killer of any income-focused portfolio: inflation. This, right here, is the brutal truth. If big government programs like universal basic income are funded by, well, just creating money out of thin air, it devalues every single dollar you have. As this quote points out, that's not some complex theory. That is what causes inflation. And if you're someone living on a fixed cash flow, inflation is an absolute nightmare. And just look at what this does to your income. It's devastating. That steady $5,000 a month feels great in year one. But if you just have an average of 3% inflation, in only 5 years, its real purchasing power has shrunk to about $4,300. Wait 10 years, and you're down to the equivalent of what $3,700 buys today. Your cash flow number is the same, but the cost of everything is going up. This is the problem we have to solve. So, the big question is, how do we defend against this? How do we stop our purchasing power from getting eaten alive? Well, this brings us to the real defensive core of our whole strategy: building an all-weather portfolio. This idea comes from the legendary investor Ray Dalio, and he calls it the all-seasons portfolio. Now, the goal here isn't to hit massive home runs. The goal is to stay in the game and protect your money no matter what the economic weather is, whether we're in a boom, a recession, an inflationary period, or a deflationary one. You'll notice it's got a lot of bonds for stability, but it's carefully balanced with stocks, gold, and commodities, which are all designed to do well in totally different environments. And here's the logic behind it, which is just so smart. The portfolio is designed to have about a quarter of its risk in each of these 4 economic seasons. So when growth and inflation are both going up, commodities tend to do really well. When growth is rising but inflation is falling, the classic boom times, stocks are king. In that nasty environment of falling growth and rising inflation, gold is your best friend. And in a deflationary bust, bonds are where you want to be. By owning a piece of all of them, you're basically ready for anything. And this whole defensive, all-weather idea, it lines up perfectly with the timeless wisdom of the father of value investing himself, Benjamin Graham. His entire philosophy was built on one thing: safety first. Principles like sticking to big, high-quality companies that have paid dividends for years and years, and, this is the big one, always buying with a margin of safety, meaning you pay less than what an asset is truly worth. It's all about building a financial fortress, not a flimsy race car. Okay, let's bring this all together. We have covered a ton of ground, from big picture philosophy to nitty-gritty tactics. So let's assemble everything into a clear, actionable blueprint you can take away from this. Here it is, the complete blueprint. Number 1, you have to shift your focus. Stop staring at the volatile net worth number and start prioritizing reliable cash flow. 2, systematically build your income engines. Use powerful strategies like the wealth wheel for stocks and the BRRR method for real estate. 3, learn to use leverage the smart way, acquiring assets that other people, like your tenants, help you pay for. 4, You must defend your income from inflation with an all-weather portfolio. And finally, number 5, be obsessed with tax efficiency. Use every legal tool you can to keep more of the money you earn. So we're going to end right where we started with a question for you to really think about. Take a hard look at your own investments, at your own financial plan. Is it built on the old assumption of a constantly rising salary and a never-ending bull market? Is your portfolio built for the economy of yesterday? Or is it a resilient, defensive, cash-flowing machine that's built for the massive uncertainties of tomorrow? Because honestly, the answer to that question could make all the difference in the world.